Well, it's just gone past 10 o'clock, so we're going to make a start. Good morning, everyone. My name's Tanya and I'm one of the regional managers for Australian Catholic Super. I'm based in Canberra and my office is on the ground floor in the St Christopher's Pastoral Centre in Monica. Our topic today is one of my favourites, retirement planning. And the reason I say this is because I've seen how much of a positive impact super can have on people's retirement lives. So even if retirement isn't imminent, it's still important to pay attention to your super and to understand the role it can play in what we hope is an enjoyable retirement. Joining me today are my colleagues Tom Rouse. Hi, Tom.
Morning, Tanya. How are you going?
Good. How are you?
I'm good, thank you, although a bit cold.
Yeah. Tom's one of our financial planners and another one of my colleagues, Justin Colley's in the background. He's monitoring the chat box and may join us at the end if we run out of time for questions and answers. On the subject of questions and answers, if you do have any, please enter them in the Q&A box down the bottom of the screen. We'll try to address them as we go through. And also this presentation will be streamed live on Facebook and there'll be a recording available on our YouTube channel tomorrow if you'd like to watch it again, or share it with your friends and family. In the spirit of reconciliation, I'd like to acknowledge the traditional custodians of Ngunnawal country, the land in which I work and live, and recognise their continuing connection to land, water and community. I pay respects to elders past, present and emerging. Before we begin, please note that any information we provide in this presentation is general in nature. It's designed to illustrate what you can do, not necessarily what you should do. So please don't take any action based on this information before considering how it applies to your own personal situation, objectives or needs. And always make sure you read the product disclosure statement and target market determination before you make any investments. And consider seeking financial advice to determine your best course of action. And here at Australian Catholic Super, we have our own team of financial planners who can help, and you can find a copy of our product disclosure statement on our website. So let's begin. What do you want to do in your retirement? Well, for me, this is the fun part of retirement planning, thinking about the kind of lifestyle you'd like to enjoy. So Tom, what do you consider is important when helping members at this stage of retirement planning?
Good question, Tanya. Look, everybody's situation is different. Whenever I see a client for the first time, I guess planning is always about goals. What do we want to achieve? So for some people, that might be more time spent with the family. For some people, it's more time traveling. I'm not too sure how many people are taking cruises at the moment, given what's going on. But I guess what it comes back to is, okay, well, we've got to set up these goals. What do we want to achieve over our retirement? And then we have to kind of quantify that. We have to attach a financial aspect to those goals. And that's where we can help on the planning side of things.
Okay. And we'll talk a little bit more about that later. I'm just going to run through why it's important to know how much super you have. First and foremost, because it's your money and forms an important part of your future. So we should keep on top of what your employer is paying into your super account. Imagine if they forgot to pay your salary. Well, by the same token, you want to make sure that they're paying the right amount into your super. And currently the minimum superannuation guarantee rate is 10.5% for all adult employees. You should work out if you want to add more to your super, and you should really be looking at this every year and set yourself some financial goals. Ask yourself, am I going to focus on putting some extra money into super this year? And also you can ask yourself, how is my super invested? That's really important. And what insurance do I have in my super? And is this insurance enough for the worst case scenario? It's also a good idea to keep up to date with the super contribution caps and what they are each year, so you know how much super should be going into your account and whether or not you'll go over the caps. And we're going to talk about this in a little bit more detail later on. And for those of us who are starting to focus on retirement, can't wait. It's good to know how much super you have so that you can see how you're tracking towards your retirement goals. So it's never too early to start thinking about what those goals might be. And I guess the last point I'd like to make is it's important to help you with some decision making. So keeping your eye on your super, it could impact some things like new job opportunities or potentially taking some time off work. So Tom, can you talk us through this slide and the relevance to anyone thinking of retirement? What's this all about?
Yeah, so I guess it's a number one question that we always get asked. Do I have enough Now, that's a very broad question. So this is where I guess planning about making sure you, in your personal circumstance you have enough is the best thing to do. So what we've got here, Tanya, is we've got kind of, I guess, what we will get if we get the full age pension. So that's on the left-hand side of the screen, okay? So this is if you're eligible for the full age pension, and we're going to talk about eligibility a bit later on. Okay. How much would you get from the age pension? So for a single person, just over 25,000, and for a couple, just over 38. So basically, that gives you a kind of modest lifestyle. So when we look at studies about, okay, a basket of goods, and we all know that those baskets of goods are going up with inflation, what does that provide? So it's really just a little bit less than what we classify as a modest lifestyle, okay? So a modest lifestyle is basically paying the bills, being able to do the grocery shopping, maybe a weekend away up the coast, but not much more than that. Most people that are wanting to plan for retirement want that more comfortable lifestyle, okay? So the studies show that for a single person, that's nearly $46,000 a year, and for a couple, just under 65. It's important to remember with these figures that they're assuming also that you own your own home, that you're not spending any of this money on rent. So if you are a renter, then you've got to incorporate that into your budget as well. But you can see there that there's a gap between, well, what the government are going to provide and what a comfortable lifestyle is. So effectively, I guess that's where your retirement savings come in, is to try and top up any entitlements that you can get in retirement from the government to that more comfortable lifestyle. All I would say is that, look, everybody's got a different level of comfortable lifestyle. I see clients all the time where they go, well, look, for a couple, $40,000, $50,000 is more than enough for us to have a comfortable lifestyle. Whereas others who, I guess, are more used to a lifestyle when they're working, and they might be having $80,000 or $90,000 a year that they're living on, then dropping back to a budget of 65 might be a bit of a challenge for them. So they might have to plan to say, okay, if we want to maintain our own lifestyle, we've got to make sure we've got a bit more capital around.
Okay, I understand. We're just going to move on to the next slide if you're ready for that one, and if you could take us through.
Yeah, so when we talk about that modest, comfortable lifestyle, the studies are produced by a company or a group called ASFA, the Association of Super Funds Australia. If you Google them, you can get a lot more detail. So they break it down about, okay, well, how much is spent on each area. So depending upon your kind of spending habits, I mean, I think mine would be more on red wine than anything. But you can have a look and have a go at your own personal budget as well if you go onto their website.
That's great. And is that something that you might help clients with when you get together with them?
Oh, definitely. It's the number one thing, Tanya, that we look at is the budget. So yep. I guess going into retirement, having a plan, having it prepared, understanding your spending habits and what you can spend in retirement, it just puts you in a lot better step as you approach retirement and going into retirement.
Yeah, that's great. Okay. And look, what are some of the sources for funding retirement?
Yes, so again, when people come to see me, Tanya, they think, oh, I just deal with super. So I'm a financial planner. I look at your holistic situation. So when we talk about a holistic view, we're looking at all the kind of things that you need to look at to plan for retirement. So for some people, they might have shares or property outside of super, which we can also take into account. For some people, it might be looking at what they do with the family home. So anyone who's seen these seminars before, they know that I talk about my mother-in-law a lot. Just a personal example, but her situation was that she didn't have a lot of super. She was approaching retirement, but she had a lot of, I guess, wealth in the family home. So she decided, look, well, I want to make sure that I've got a comfortable retirement. I can top up that age pension with liquid funds. So that's where she downsized the family home, topped up her super, and again, we're going to talk about contributions to super later, and that then gave her the superannuation and liquid money to be able to go and enjoy the retirement that she wants. It's not for everybody. Some people's goals are obviously to maintain the family home for as long as possible, pass it on to the kids. So, but this is what we discuss. We discuss all these kind of options that are available to people.
Yeah, and as you said, it's certainly different for every individual person that you speak to. Not everybody has shares, but then some people
Exactly.
won't have investment properties. There's just a couple of questions that come through. Most of them will be addressed later on during the session, but we'll make sure we get to all of them. But one of the ones that's, I suppose, more relevant right now, I'm going to flick back a slide. One of our viewers has said, is a larger version of that information on the slide available? It is very hard to see. And yes, you are correct. So this is all the different budgets. But as Tom mentioned, if you Google ASFA retirement standards, so I'll just say that again, ASFA retirement standards, you'll be able to find all of that information on the ASFA website. Okay, so we're just going to move back along into this next slide. So Tom, can you please explain the tax benefits of investing within super for retirement? What's this all about?
Yeah, this is, I guess, why people come to see me a lot, is really planning around these tax benefits. So again, when I see clients for the first time, the most important thing for clients to remember, and for everybody to remember, is all super is a tax vehicle. Okay, a lot of people think it's like an investment. It's not an investment, it's a tax vehicle. Once your money is in super, then you choose the investment and how you want it to be invested, whether you want it to be in property, shares, term deposits, or a mixture of all those different types of investments. But coming back to what super is the tax vehicle. So effectively, the interest that you earn within super is taxed at up to 15% while it's invested. Apologies, excuse me. That's a lot better than most people's marginal tax rate while they're working. Putting money into super as a concessional contribution, again, it's only taxed at 15%. We're going to talk about that in a minute. And then the ultimate kicker is when you do retire, okay, and you have money in what we call an account-based pension phase, the interest that you earn on that money is all tax-free. Okay, you don't have to put it in a tax return. And there's no capital gains tax issues. So that's all super is. The catch with super, there's always a catch. When can I get it? So that's the kind of biggest downside to super, is access. But basically, if you're 55 plus, and we'll talk about it, that access is almost gone, or will go by the time you're 60. And you've got all the upsides of using super as this tax vehicle to minimise the taxes that you pay and maximise your retirement savings.
Right. Okay, that's good. And I think some of the discussions we've had with people over time is they often come and see us and think, well, why should I be putting my money in super when I can potentially put my money in something else, in an investment property? And so are you saying, Tom, it often just comes down to the tax?
That's all it is tax. Yeah. So if you're young and you buy an investment property, the ability outside of super is, well, you can sell the investment property, use those proceeds to do something before you retire. Okay, so generally speaking, when you're 20, 30, well, if you've got 40 years to wait to access your super, it's not very attractive. Whereas, as I say, 50 plus, when you're getting closer to that ability to access super tax-free, you can use the super vehicle as this tax vehicle to maximise your retirement savings.
That's very interesting. So we've talked about the tax benefits of saving into super and that fantastic zero tax pension end goal. I love that. Now we're going to talk about the ways to grow your super and build it up. So Tom, a lot of people talk about salary sacrifice. Why is salary sacrifice a popular method of building up super?
Yeah, good question. So on the screen here, what we've got are the marginal tax rates. Okay, so the first point is salary sacrifice is not for everybody. Okay, if you're on a low taxable income anyway, i.e. you're earning less than $18,200 a year, well, all that money that you get is tax-free anyway. That's the tax-free threshold. We've got to remember that putting money into super as a salary sacrifice, i.e. before you've paid your marginal tax rate or your income tax rate, there's a flat tax of 15%. Okay, so because it's a flat tax, then every dollar that you earn over $18,000 a year, well, you're saving money by putting it into super rather than having it as take-home pay. So just for example, if you're earning over $45,000, well, every dollar that you earn over $45,000, you have to pay 32.5%. Well, it's actually 34.5% when you include the Medicare levy. Whereas if you put that dollar into super, because you're only paying 15% tax on that dollar, then instantly you've got a return there on your money through the tax system. Now, when you look at it as a percentage return, it's roughly about a 30% return when you start looking at that marginal tax rate of 34.5% plus. Now, that's a guarantee. That's before you've actually invested the money. Then the money gets invested, and then the interest you earn on the money is, again, only taxed at 15% rather than your marginal tax rate. Okay, so this is why the government put limits on how much you're allowed to put into super as what we call a salary sacrifice or pre-tax contribution, because otherwise millionaires who didn't need the money would be putting all their money into super and avoiding tax. So it is one of the most effective ways, because that's a guaranteed return on your money through the tax system. Again, going back to what the catch is, Tanya, you can't touch that money until you meet what we call the condition of release.
Well, there's always a pro and con.
Yeah. Yes, exactly.
Always the pros and cons. I think maybe the next slide you can talk a little bit more about salary sacrifice and the caps and how all that works.
Yes, definitely. So, and we'll talk about, I think there was a question as well about putting money into super, okay?
Yes.
Which we'll get to as well. So effectively, as we've already mentioned, that these pre-tax contributions, or what we call concessional contributions, look, there's lots of names for them, so it can get confusing. But basically, concessional contributions make up what the employer puts in. So the super guarantee, which has just gone up to 10.5%. The salary sacrifice contributions that you put in before you pay any income tax. Any additional employer contributions. So living in Queensland, I know that the diocese up here, if you do work for the Brisbane diocese and you make an additional contribution to your super, the employer will also make an additional contribution on top of that 10.5%. So they all count towards this $27,500 limit, okay? There is also the ability to put in what we call a personal deductible contribution. So this is where you can put in a lump sum throughout the tax year. And then if you want to claim a personal deduction on that lump sum for your tax return, then that will count towards that $27,500 limit, okay? So you can take advantage of, I guess, minimizing your tax in a number of ways, either on a regular basis through salary sacrifice or by doing it ad hoc with any lump sum personal deductible contributions.
This one, I'll just have a quick chat about this slide. I was thinking about maybe answering one of the questions, but I think maybe we can cover that one off in another couple of slides. The superannuation guarantee rate will continue to increase from where it is now. And as Tom mentions, it's only just gone up to 10.5% per annum, which is fantastic. And it'll keep increasing until it reaches 12% on the 1st of July 2025. And why is this happening? Well, the reason is we're living longer. And so that means, you know, we used to all drop off the perch in our mid-70s, and now that's pushing out. So life expectancy is increasing, which is wonderful, but it also means we'll be retired for longer, and we need our super to last the distance. So because of this potential risk of what they call outliving your retirement savings, the government has legislated these increases to assist with self-funding our retirement and to rely less on the government pension in the future. So that's good news to some of our younger people that are online today. That means that hopefully your super will help grow at a greater rate of knots and provide you with a little bit more of a benefit in the future. And Tom, if you can take us through the other type of contribution. We've already talked about the concessional contributions. Now we're talking about the non-concessional. What do those terms mean, by the way?
Yeah, I'll just skip back a bit, Tanya, because there is a question about the personal deductible lump sum.
Do you want me
So I'll just read the question. Are there limits on the amount of personal deductible lump sum contributions you can make? Okay. So the limit is basically that $27,500 a year, okay, which you can claim up to and get the tax benefits from. You've got to remember that that limit includes what employers put in, okay, as any super guarantee, if any. And the caveat as well about claiming a personal deductible lump sum is that you can only do it if you're under 67, or if you're over 67 and under 75, you have to meet a work test to be able to do a deductible or personal deductible lump sum, okay? Now, there is also, this is where we start getting into, I guess, complex territory, but there is also something called a carry forward provision of these concessional limits, okay? So what I mean by that is the government introduced a rule that, and this was back in 2018, that if you have a total super balance, so that's money in superannuation in all superannuation funds that you hold of less than $500,000, then what you're allowed to do is actually carry forward any unused cap from previous financial years and add it to that $27,500 cap for the current financial year. And you can actually go back 5 financial years in total if you have any unused cap. So there is actually the ability for people who do have less than $500,000 in super to potentially put in more than that $27,500 and reduce their tax even further. All I would say is if you're thinking about doing that, definitely go and get some advice because it's a complicated area, okay? So that's the concessional side of things. Just moving forward to the non-concessional, again, all these terms, what non-concessional means is after-tax contributions. So basically money from your own bank account or money from your pay where you've already paid your income tax and then going into super. So this is a separate limit, okay? So you've got to look at these as 2 separate limits, the concessional and non-concessional. Now, the great thing is, and I think we'll talk about it in some of the updates, but from the 1st of July this year, they've really opened up the non-concessional contributions for the ability for people to put money into superannuation. So basically, if you're under 75, then you can add up to $110,000 a year into super and up to $330,000 in one hit. But that means you use up what we call your bring forward contributions, that you can't put any more contributions in for a 3-year period. So this has really opened up the ability. So if we do have any people who are over, 67, where it used to be the age where you couldn't put money into super if you're not working. So now you've got to think, okay, well, if you've got money outside of super and you want to top up your super, then there's the ability to do so.
That's great, Tom. That might be a good time to answer one of the questions as well, which was, I work 1 day a week. Am I still able to put money into my super scheme?
Yeah, very good question. So, well, as long as you're under 75, okay, and you haven't broken any of these limits before, you've got to remember that they take into account what you put into super previously, but there's the ability all the way up to 75. So no matter whether you work full-time, part-time, not at all now, okay, you can put these after-tax contributions into super, okay? In terms of the personal deductible contributions, if you're under 67, you can put those into super no matter how much you work. After the age of 67, you have to meet a work test still. So they still have that, I guess, old work test, which they used to have for these non-concessional contributions. And they still have that in place if you're wanting to make a deductible contribution to reduce your tax.
Which answered, I guess, a little bit of one of the other questions that came through. It was, if you have more than 500,000 in super, can you add in the extra deductible sum up to 27,500 for the current financial year?
Yeah, so effectively, if as long as it's appropriate and that's what's in your personal situation, the best thing to do, then you can top it up to the 27.5, even if you've got more than 500,000. It's just that if you've got more than 500,000, you can't carry forward any unused cap from previous years.
Another question, what is the benefit of a non-concessional contribution?
Very good question. So when you put money into superannuation as an after-tax contribution, unlike the concessional contribution where the government take a flat tax of 15%, the government don't take any tax because you've already paid whatever tax you've had to pay. So they don't take any additional tax putting this non-concessional contribution in. The benefits are all about the tax on the interest that you earn, okay? So again, if you have $100,000 outside of super, and even if it's in a term deposit, and you're probably getting your 0.5% or 1% return, okay? Well, you've got to include that $1,000 a year interest in your tax return. Then you get taxed at whatever marginal tax rate, 30, 40%. So really, your net gain is after that tax. Whereas having that money inside superannuation, when the super fund earns interest on the money, even if you're still working, they only pay the 15% tax on the interest that you earn. And then ultimately, once you're retired, they pay no tax on the interest that you earn. So again, it's all just about super being a tax vehicle. And that's why they put limits again on these after-tax contributions, because again, millionaires would be able to just top up their super and avoid all the tax on the interest that they earn. So that's why they always have these limits.
Yeah, it can get quite complicated, it seems, Tom. It is when you're sitting down with your clients and helping them figure out, you know, what do I do with this income or these savings that I have? Is this the sort of stuff that you work through with them?
Oh, all the time, yeah. So look, at the end of the day, planning is about using the rules to your advantage and making sure that, well, whatever the goals are, we always go back to what are your goals? How do we meet those goals in the best way? Okay, so for some people, focusing on super is the right thing to do. For some people, it's not. I mean, we had a question here that would it not be better to place money both in super as well as property, despite tax benefits? That might be the case, but they're not the same. So again, you've got to remember, property is not the same as super, okay? If you want it, so property is an investment, just like shares, just like term deposits, just like bonds. All super is a tax vehicle, okay? So this is where if somebody really wants to buy property, or do they consider buying a property inside a super fund? Okay, now you can't do that through traditional industry funds because obviously they don't have the ability for you to individually buy a property. But that's where self-managed super funds come into play. So, I mean, for some people, that might be the right way to go. So everybody's got a different situation, and that's what we'll sit down and talk about whenever we look at your own situation.
Okay, there's one more contribution question, then hopefully we can get on to the next section.
That's all right. Yep.
Yeah, somebody's asked, I have a salary package arrangement for living expenses, etc. for maximum amount. Can I still put money into super on top of this?
Yeah, very good question. I get this actually quite a lot, and it's quite confusing. So salary packaging is a separate limit to salary sacrificing. Okay, very confusing because it's just one word difference. But salary packaging, so most people kind of, what I see is package a car. They might package the mortgage if they work for a charity or an NGO, non-government organisation. So they're actually separate limits of what you can do there and get the tax benefits versus the salary sacrificing to super, where we've got that $27,500 limit, which includes what the employer puts in. So you can actually do both because they are separate caps. You just got to make sure in your own individual circumstances that you're making, I guess, the best decision around how much do you put where.
Okay. One more question. To contribute to non-concessional, do I have to have already reached the concessional contribution cap of 27,500?
Oh, again, yeah, very good question. No, you don't. So basically, they're two separate caps. So whatever you decide to put in, you can have concessional contributions, non-concessional contributions. Effectively, they're just two separate caps. You don't have to trigger one to meet the other.
Okay. And another question, if you convert to pension phase, can you still contribute to your super?
Okay, yeah, another good question. So we'll talk about this, but pension phase is a separate phase, okay? Once you move superannuation from super to pension phase, you can't directly add to a pension product, okay? You always have to add money to superannuation phase first, and then you can convert that money into pension phase, but you always have to add to a super account first.
Okay. I'm going to move on, and hopefully we can get to all the other questions in the next part of the session. All right, well, let's talk about some other ways to contribute or build up your super. One of the ways is to consider consolidating multiple super accounts into one. A lot of us have multiple accounts, right, from having different employment and different jobs. So consolidating multiple super accounts into one can help you save on fees, but there is a little bit of a warning here before you do anything. It's always important to be sure to check on the features and benefits of each super account that you have to make sure that you don't close an account that has important features. And probably the best example is you might have insurance cover in one super account that you might not be able to get elsewhere. And this insurance cover might be valuable to you if you have health issues. So please check the details before you make any moves to consolidate your super. And Tom, I might ask you if you wouldn't mind just spending a little bit of time taking us through downsizer contributions, which is one of the more recent new types of contributions that a lot of people are enjoying, and a little bit on spouse contributions and how they might work.
Yeah, I'll talk about the spouse contributions first. So with the spouse contribution, this is classified as what we call that non-concessional contribution. So it does count towards that limit, okay? But what the government have done for many years is they've tried to encourage, I guess, where you have one spouse who's working, one spouse who's on a part-time work or a lot lower income, to try and top up that lower income spouse's super. So what the spouse contribution is that if you put $3,000 or up to $3,000 into your spouse's super, the lower income earning spouse, if they're earning less than $40,000 a year, okay, it used to be a lot lower, but they've increased that threshold. So if your spouse is earning less than $40,000 a year, the higher earning spouse will be able to claim a tax offset in their tax return. Now, the maximum tax offset that someone can get is about $540. So not a lot, but I just look at it as a percentage return on your money, that if you can get it and you put $3,000 in, that's an 18% return on your money, because that's what you get off your tax bill.
Right,
so
that's a good way of looking at it.
Exactly, there's not many investments in life that'll give you a guaranteed 18% return.
Yeah, so it's just one of those little things that you can do.
Exactly, and that's the thing, all these little things add up over the years, so that's something to consider. The other type of contribution, now this is a special type of contribution called a downsizer contribution. Now this is actually separate to all the other types of contributions that we've talked about, so this is another separate limit, okay? Now, what the downsizer contribution was introduced for was those retirees, I guess, are over 65s. It's now over 60. So to be able to use this downsizer contribution, you can be over 60. But if you've lived in your own home for more than 10 years, you downsize. So basically, you've got your empty nesters now, the kids have gone, and you just want to downsize into a unit or a smaller two-bedroom house, for example, and then you've got money left over from the sale of your own home. There's the ability to top up your super using this downsizer contribution by up to $300,000, okay? And if you're a member of a couple, that's $300,000 each to top up your super to basically enjoy for retirement. Perfect timing for a story that I had a client yesterday came in. She's single. Basically, she was living in a house with housing property prices. They've obviously gone through the roof. So she decided, look, I've only got about $200,000 in super, and I really want to try and enjoy my life. So she sold her home, and she's going to buy a unit for about $600,000. So she's actually going to have nearly $700,000 left over, which she wants to invest. So for her, what we're looking at doing is not only using that non-concessional rule, okay, but also using the downsizer rule, so she can actually top up her super by $630,000 in one hit, to be able to then enjoy that money for retirement. Now, again, that's a personal situation, but it's how do we use these rules for our own benefit? So definitely, if you're thinking about downsizing or moving, then come and have a chat, because there are options that are available. I'll give you another example, Tanya, that a client came to me, they found this perfect place, they wanted to buy it, but they needed to put a deposit down. Okay, so what they ended up doing was the ability to take the deposit, the 10% from their super, paid the deposit. When they sold their property, obviously pay the rest, and then when they sold their property, be able to back up their super with the surplus funds that they had. So again, you can use your, so these are the sorts of things that I guess you need to think about. So it's always wise to come and have chats when you're going through these sorts of major events.
Yeah, that's very interesting.
One I just forgot the caveat on the downsizer, Tanya, is that you have to have lived in the home for 10 years. Okay. And that the contribution that you make into super has to be within 90 days of the sale of the house.
Right. Okay.
Yeah.
So you can't sort of think, oh, I did that last year and I didn't do anything about it.
Exactly. Yeah. So this is why I guess planning for it is always, you've always heard that old adage, fail to plan, plan to fail, that planning is always a good idea if you're going through these sorts of things.
Okay, quick question that kind of relates to this. One of our viewers is put in, can you have too much super? Are there disadvantages for high balances?
Okay, good question. I mean, it sounds probably counterintuitive, but sometimes you can have too much super, and that's the only reason for that is because the government put limits on how much you can get into super. Okay, so when we talk about that non-concessional, i.e. topping it up, if you actually have more than $1.7 million in super, all combined, you're not actually allowed to put additional contributions into super from your own bank account, except with this downsizer contribution. So if you are in that lucky position where you've got nice problems to have, but if you are in that lucky position where you do have more than $1.7 million in super, and you've even got more money that you want to get into super, then this downsizer again can help to do that.
Okay. Can you take us through some of the recent changes?
Yeah, so we've actually talked about a few of these. I guess on this first slide, some of the ones that we haven't talked about. So if you have an account-based pension, or you're starting an account-based pension, which we'll talk about in a bit, the government has extended what we call the minimum drawdown rule or requirement, and they've kept it at 50% of the usual minimum drawdown. So the usual minimum drawdown, if you're 60 to 65, is 4%. 65 or above, it's 5%. So it's been kept at 2 and 2.5% as the minimum drawdown that you have to take. You can always take more if you're able to. So for some people, that's good because they might not need the income and they can just draw down a minimum amount. Okay, that's due to expire the 1st of July 2023, as long as there's no major shocks again with what's happening in the stock market. So I guess we'll wait and see with that one. The government have also got rid of a little, I thought it was a silly rule anyway, but it's what we call the super guarantee threshold. So previously, if you earned less than $450 in a month, the employer didn't have to pay super for you. Now, whatever you earn, the employer has to pay super at 10.5%. Okay, so I think that's a very good thing, especially for those low income earners. The other rule changes, which we've kind of talked about or touched on, people aged 67 to 74, they will no longer have to meet that work test to make those after-tax contributions. Okay, the bring forward rule, again, that's increased now. So again, if you're between 67 to 74, you can use what we call this bring forward rule, which is being able to put up to $330,000 in one go. So as long as you're under 75, you can use that rule as well. And then we've touched on the downsizer, that they've reduced the ability, reduced the age for people who want to use that downsizer rule to 60. Okay. And then we don't see this a lot, but the first home buyer scheme, now they can save up to $50,000 to help towards a deposit through the first home buyer scheme. So don't often talk to a lot of younger members, Tanya. They're usually not too interested in super, but if there are any younger members here, or if you've got kids that are saving for a deposit for their first home, definitely worthwhile looking into that first home buyer scheme to see how that might be able to help.
Speaking of younger members, somebody's asked the question, does the SG rule apply to under 18s? Oh,
you're very good at a segue, Tanya. So so basically now, as long as they're earning over, there's no age on that. So as long as they're 450, as long as they're earning something, then the employer has to put in that super guarantee.
Yeah, that's good. That's good. All right. Moving right along. So we've talked about ways to grow your super through contributions, etc., and to build it up before retirement. Now, Tom, can you please take us through when someone can access their super and under what circumstances? Because that's often the burning question. When can I get at it?
Yes, it is one of the burning questions. When can I get my money? Depending upon the year that you were born, is actually depending upon what we call a lovely term called your preservation age. So if you were born between 1st of July 62 and 30th of June 63, your preservation age is 58, and then it increases to 60. So for everybody, they might change it, but for everybody at the moment, their preservation age at the latest is 60. Okay, now 60 is kind of the golden age, because if you do access super before the age of 60, if you were born before those dates, there may be tax consequences involved. So generally speaking, that I don't see too many clients now access superannuation before the age of 60, because if they're close to 60 anyway, and they know from 60 that they can guarantee access tax-free, then most people hang off until then. Okay, not to say that you can't, but I guess that's kind of the general rule that I see happening at the moment. So around then access, once you've met your preservation age, depending upon what happens with work, will then depend upon whether how you can access your super. Okay. So to access your super as a lump sum, i.e. just take money out when you want, tax-free, after 60, as long as you ceased an employment arrangement after the age of 60, your super becomes like a bank account. You can touch your money, you can take it when you want, how you want, okay? Even if you go back to work, part-time, full-time, whatever, as long as you've ceased that employment arrangement, you can access your super, okay? I guess if you cease an employment arrangement and then you go back to work for the same employer on the Monday, the tax office might question you if that was genuine. But if you go and work for a different employer, that's fine. And then the other thing is, as soon as you've turned 65, even if you're working, again, you've got full access to your super. So I often see, Tanya, a lot of clients that come in, they might be 66, 67, and they're still working. And they didn't realise, well, actually, I've got access to my super. So just remember that age 65 is the ability to access super tax-free.
There's a question which you've kind of answered, but it might be worth just addressing again. When can I access my super? Well, that depends on your preservation age. And do I have to completely retire, or is it possible to access super when you were still working part-time?
Yeah. So again, if you've left an employment arrangement after the age of 60, even if you go back part-time, full-time, whatever, then you can access your super, okay, as a lump sum, as an income stream, no limits. If you say you're working for the same employer and you reduce your hours, okay, and you're over 60, well, unless you're working less than 10 hours a week, okay, and that's what's classified as substantially retired, okay, so working less than 10 hours a week is classified as substantially retired. If you're working more than that 10 hours a week still, you can't access your super as a lump sum. What you can do if you're over 60 is you can access superannuation in the form of transition to retirement, okay? So we're going to have a chat about this, and that's where we get an income stream. Now, there are rules and regulations, and one of the questions here, Tanya, was how do we get a transition to retirement phase? Is this automatic? No, it's not automatic, okay? You have to opt in to converting your super into a transition to retirement account, and you can only do that if you have met your preservation age, okay? So you can only convert to a transition to retirement account if you've met your preservation age. So I think if you skip forward a couple of slides.
I think I might do that, yeah.
Yeah.
We talked about how, you've already mentioned that you can take it as a lump sum or an income stream.
Yep.
And now, moving from super to pension phase, you've got to opt in.
So effectively, while you're working, you've got your super phase, okay? Once you've met your preservation age, then you can look at these, what we call retirement phases or transition to retirement phases. So that's where you can transfer what you've built up in super and move it across into a separate account in this phase. Again, you've got to remember, the key thing to remember is that you've got two phases and two accounts, okay? If you're still working, you still need a super account because contributions, again, always go into that super account, okay? But what transition to retirement is the ability to transfer money from that super phase into the transition to retirement phase. And I think, Tanya, on the next slide, we've got the rules around it, okay? So the rules around this is, so this is a phase where you're still working, okay? So you're not substantially retired, you haven't left an employment arrangement, you're either working full-time or more than 10 hours a week, okay? But what it is the ability to take money from your super, and if you're over 60, those payments are tax-free, and have another income source, which is tax-free to do what you want with. So this is where it gets interesting, because I guess this is where people go, well, why would I need another tax-free income source? Okay, well, there's three main reasons. The first one, which is what it was designed for, is that as transition to retirement says, that you might be working full-time, you want to reduce your hours to 2-3 days a week, but you still want a full-time salary to live on. Okay, so that's where you can start accessing a bit of your super to top up the drop in pay from going 2-3 days a week, okay? The other two main reasons, though, why you might want to look at it is if you've got another income source, okay, that's tax-free, that then gives you the ability, if you're still working full-time, to actually put extra contributions into super and take advantage of that $27,500 limit without impacting your overall take-home pay. So it's the ability to take advantage of the income tax savings through salary sacrifice, but then draw money out tax-free to ensure that, well, any take-home drop in pay that you have from extra salary sacrificing, you replace that with this tax-free income. And so it's the ability to basically save on tax, and rather than that tax go to the tax person, it's going into your savings for retirement.
That's very interesting. Yes.
Well, it's complicated because there are limits and there are rules on what you can do.
Yep.
But definitely, if you turn 60 and you're still working full time, maybe for another 3, 4, 5 years, and you're not already salary sacrificing up to the cap,
Yep.
that can be a very attractive strategy to have a look at. So that's one of the things that we look at when we speak to clients. The third main reason, a lot of clients come to me and they've still got quite a bit of a debt. Okay, and they're worried about the debt. I guess within rising interest rates, and they're going to be paying more on interest, you might be able to use that income stream source to reduce your debt quicker, so if that's something that's suitable. So again, there are options available with this transition to retirement strategy, which we look at.
Great. We're just going to zoom forward, talking about allocated pension. You've spoken a lot about pension accounts. What's the difference, I guess, between an allocated pension and a transition to retirement pension?
Yeah, so there's three main differences, okay? So an allocated pension, it's basically exactly the same as a transition to retirement pension, except the rules are kind of more relaxed, okay? So I should have mentioned, from the transition to retirement pension, there is a maximum payment that you can take each financial year, which is 10% of the account balance. An allocated pension, there's no maximum. You can take what you want when you want. The other major difference is that with a transition to retirement pension, the interest that you earn on that money. So again, remember, this money is still invested and earning interest for you. Transition to retirement, it's still taxed like super, up to 15%. In allocated pension phase, that's where you get the tax-free interest. So you get better returns over the long term, okay? And then the third major difference is the ability to take lump sums. That with an allocated pension, if you want to take a lump sum from the account, you can just request a lump sum to be paid to you. Whereas a transition to retirement, you have to receive those as pension payments. You can't just take a lump sum.
Okay. Interesting. All right. We're going to move forward. We're kind of getting a little bit short on time, and I know there's a bunch of questions that we haven't been able to answer yet. So we'll see how we go. We've got a next section talking about age pension and how that interacts with retirement. And hopefully at the end, if we've got any time, we'll address those questions. If not, we'll come to you individually after the session. As we said, this next section covers the government age pension. Tom, what are some of the considerations when it comes to accessing age pension?
Yes, so as we've got on the screen, the major thing is your age. Okay, so are you age pension age? So it's important to remember, and again, speaking to my mother-in-law, she turned 65 and she thought automatically, yep, I'll go on the age pension. She was born in 1954, so her age pension age was actually 66. So just remember, and for most people, it's going to be 67, and they might even put it up to age 70, probably for the younger members here, that they keep increasing it. So age is the first requirement. So again, that's different from when you can access your super. Okay, so super has different ages of access. Age pension, again, has a different age. Then what they do is they look at, okay, are you eligible? So once you've met your age, how much assets do you have and what income comes in? And then depending upon those two tests, they apply those tests separately. Will depend upon how much you're going to get paid. Okay, so the next slide, I think we've got just to check your date of birth. So there you go. If you are born before 1955, 1st of July, you've already met your age pension age. And then for everybody after the 1st of January 57, your age pension age is 67. Okay, so just to remember those dates. So once you have attained age pension age, the first test that we'll talk about is the assets test. So this is, I guess, for most people that have retired and they don't have any employment income coming in, this is the test which decides whether they get an age pension or not. Okay, so what we've got on the screen is for a single person, and what they look at, are you a homeowner or a non-homeowner? We'll talk about homeowners first. That if you have assets of roughly over $600,000 now, so the threshold's gone up a bit, then if your total assessable assets that they assess is more than that, you won't get any age pension. Now, what are assessable assets? It's basically everything except your own home. Okay, so your own home is not classified as an asset, but they count everything else: super, money in the bank, shares, any other properties you've got. They add it all up, even your car, your contents. If you have less than 600,000, then that's where they start giving you a part age pension. And then the further, the less that you have, and then if you're below 270,000, that's where you're eligible for the full age pension. Okay, anywhere in between on that blue portion, that's where you get a part age pension. Okay, now for 70% of people retiring today, the age pension is going to form part of their retirement. That'll be less over time because people will have more super, but the age pension is going to be a key factor in most people's retirement. Then for a couple, slightly higher thresholds because you're a couple. So for a couple homeowner, it's 900,000, where the cutoff point is not to get any age pension, and then the full age pension if you're under 400,000. Now, we talked about how the house or the primary home, the home that you live in, isn't counted as an asset. Okay. One other asset, if you're a member of a couple, is if you have money in superannuation for a younger spouse who's under age pension age. So this is a key factor for, especially for those couples where there is a bit of an age gap, an age difference, where you can plan that, well, if one of you is going to get to age pension age first, and then the other one is a few years behind, well, while that younger spouse is under age pension age, any money they have in superannuation phase, so that's the key, is not in pension phase, it's in super phase, that does not count towards the asset test for the older spouse. Okay, so that's the only other asset that's not counted. So again, planning for the future, and this is what we do all the time to try and maximize any Centrelink benefits, it can be quite important if you're a member of a couple. Okay, so, and it's nothing to be sneezed at, because if you do manage to get the age pension and you structure it right, there's the ability to get nearly $18,000 plus that valuable pension card with all the benefits each year that the spouse is under age pension age. So definitely worth looking at. So that's the assets test. Then they also apply an income test. Okay, so if you are still working, obviously, and you're over age pension age, then they're going to count the gross employment income that you earn towards the income test. Okay, but what's important to remember here is even if you're working, it does not automatically disqualify you from an age pension because they have thresholds. So again, I often get clients come to me, Tanya, who said, well, I was working 2 days a week and I just didn't think I was entitled. Well, no, it depends upon how much you're earning. So for a single person, if you're earning less than $56,000 gross a year, or your income is less than that, then you're eligible for a part pension. And as a couple, it's actually up to nearly $86,000 gross a year. Okay. Again, they always look at you as a couple. So if there's a younger spouse working, they're going to take that younger spouse's income into account. But it's just, I guess, to think, okay, don't think automatically because I'm doing something I'm not entitled. You need to look at your own situation, and that's where we help. Okay. So that's the income test. And then obviously, depending upon those two tests, they apply both tests. They go, okay, well, how much are you entitled under the income test? How much are you entitled under the assets test? And they're so generous that they pay you the lower of the two amounts. Okay. But the maximum that they will pay you, as we kind of stated at the beginning, for a single person, that's just over $25,000 a year. As a couple, it's just under 39 a year if you're both eligible. And remember, if one of you's over age pension age, one of you's under, you get paid the couple rate, not the single rate. So the maximum that you could get is about $19,000 a year as a member of a couple. But if you are separated to ill health, that's generally when someone might be in aged care, someone at home, then you do get actually the single rate each.
Great.
Okay.
And Tom, Commonwealth Seniors Health Card.
Yes. So a lot of, I guess one of the questions that we've had, I just saw it pop up there. If you're single and fall just over the threshold to get a part pension, as you support yourself, then and fall under this amount, then do you get a part pension? So if you fall back under the threshold to get a part pension, yes, you'll get a part pension. So Centrelink always just look at your situation at a point in time. So again, it's quite important to, I guess, keep on top of, if you are just above the threshold, what your total assets are. I mean, superannuation accounts have gone down a bit over the last 6 months due to the stock market, or most people's have if they're taking a bit of risk. So that might have then dropped them below thresholds. So definitely look at your situation. The other thing that I would say is come and have a chat, because there are other strategies and other products which might be suitable, that if you are just above the threshold, that we can plan to get you below the threshold. So again, there are some strategies out there for those members where they might just be above the threshold to get below the threshold to get that part age pension. Okay.
Yeah.
But if you're not eligible for the age pension, because you've got too many assets, then there is something called the Commonwealth Seniors Health Card. Now, this gives you the discounts on doctor visits, cheaper medicine, and this isn't asset tested. What it is it's income tested. Now, again, if you're retired and you don't have employment income coming in, for most people, the income that Centrelink will count is something called deemed income. Okay, so that's where they look at your financial assets. They do something called deeming, where they assume you're getting an amount of income from those assets. And effectively, that counts towards this income test. Now, unless you've got about 3 million plus as a couple and probably nearly 1.5 plus as a single, you're still going to be eligible for this card. Okay, so 95% of Australians will be eligible for this Commonwealth Seniors Healthcare Card. The criteria is that you have to have reached your age pension age. Okay, so definitely apply for that card if your situation is that you're not working and your assets are below a certain threshold.
That's great. I might just add a little bit as well to the person that asked about, being on that threshold and maybe eligible, maybe not. Centrelink rely on the individual to update them when the individual's situation changes. And so, for example, as Tom said, if your superannuation balance drops because you've potentially spent the money, then Centrelink aren't necessarily going to automatically increase your age pension entitlement. It's up to you to inform them. And then by the same token, if you get an inheritance, for example, which does happen to a lot of people, and suddenly you've got more money in the bank, it's important that you update Centrelink to make sure that you still are entitled, because the last thing you want to do is for Centrelink to find out that they've been paying you age pension benefits where you weren't actually entitled to that. So there's a lot of personal responsibility that goes into managing that whole age pension process. All right. What else is available to our retired friends out there in the community? Yes.
Check your state or government benefits. So if you go onto the state websites, they often have a link about concession card holders and what they might be entitled to. A very interesting one that I came across was retirees that are moving to the state of Victoria, for example. So I had someone moving from New South Wales to Victoria. Not too sure why they would do that. Apologies to Victorians in the room. But the state government actually gave a discount on the stamp duty if they were a concession card holder.
Yes.
So just little things like that. It's always best to check the state websites to get those kind of discounts.
Yeah, that's right. It's not a national program, is it? The seniors card. It's by state or territory. And Tom, can you please just talk us through some of the other topics that you can help your clients with?
Yeah, so I'm not a solicitor, Tanya, but if you speak to every solicitor and every financial planner, they will always tell you, make sure you've got a will, make sure you've got powers of attorney, and make sure that you've nominated a beneficiary on your super or allocated pension. Now, again, a lot of clients that I see, they automatically think that their super goes to their estate. It's not the case. Super is actually totally separate to your estate, and because technically you don't own your super, the super fund does. You're a beneficiary of a trust. So that's how the structure works. So because you're not technically the owner, that's why the trustee has the ability on who they pay that money to. Okay, they might pay it to the estate, But if some people step forward and say, well, I want a slice of the pie, they have to take that into consideration. So if you want certainty, then the general best course of action is always to nominate either a binding nomination on your super, or if you can, a reversionary beneficiary on your pension. So that's where money will automatically go to the people that you nominate, and it doesn't actually go via the estate. And it can't be contested if it's binding. So it is very powerful. Now with binding nominations, they have to be updated on your super account every 3 years. You will get reminded by the super fund about that, but definitely have a look. If you don't have a binding nomination, it's not like the super fund will keep it. They will still pay the money to people, but they ultimately have discretion of how the money is paid. There is also strategies as well around estate planning, because not many people are also aware that even though your super is tax-free to you, tax-free to spouse, if super does get passed on to mainly adult children who are classified as non-dependents for tax purposes, then they could pay up to 17% tax on the money that's passed to them. So we all know, or it's been for many years now, that there are no death taxes in Australia. That was got rid of a long time ago, except for money passing from superannuation to adult children. So there are strategies, and generally these strategies we look at from the age of 60 plus when you can access super. But there are ways and strategies to make sure that if it's important to you, you can minimise the tax that is payable on any money that passes to adult children. Okay, so we plan for that all the time as well, and these strategies have actually opened up for all the way up to 75 now. Two caveats to that, Tanya, is I always say this to members: doesn't benefit you, only benefits the kids. That's the first thing. So some people say, well, if they get what they get. And then the second thing is you may spend all the money anyway, so which is the plan for most people. So but I guess if we all knew what was exactly going to happen in life, it'd be easy to plan. So
there's some very interesting points there, which I suppose leads on to how can we help? So you can talk to your regional manager, me in the Canberra region. We've got them all around the country. Our job is to deliver personalised service and information to our members. So if you'd prefer to meet with somebody face to face, we can be available to them. Otherwise, you can always contact our helpline team by calling 1300 658 776. Tom, can you please explain our financial advice services?
Yeah, certainly. So we've actually got two types of services for personal financial advice. So the first one is what we call limited advice. So this is, I guess, tailored towards just specific topics and questions. Okay. So I've got to get my wording correct, I think, here, Tanya, that this is a service that's provided at no additional cost. Is that correct?
That is correct. It's part of the member fee. Yeah, it's like
it's part of your member fee, effectively. So you can. It's all done over the phone. So just to obviously keep costs down. But what they can talk about, probably the two biggest topics that members can benefit is super contributions and investment choice. So that's the one that I would say that if you come here today and you just want to have a chat, definitely book in to speak to one of the limited advice team. They're fully qualified financial planners, but all they can do is give you advice on these specific topics. So if you want to know, well, how do I get up to the $27,500 limit? How's it going to impact my pay? Help me with the calculations. That's great. The other one, which I would implore people always to look at, is how their money is invested. Okay. While things are going well, you never think about it. Okay. But the super fund is always making, I guess, an assumption on the level of risk that you want to take with your money. Okay. Now that might be right or wrong. So a lot of people that I see, Tanya, I'm sure you get the same, is if you're in a balanced fund, for example, with the super fund, they always go, okay, well, balanced is safe, isn't it? No. So generally balance means a mixture of lots of different investments, which could mean ups and downs and depending upon what happens in the market. So this is where the limited advice team will give you a recommendation that suits you and says, okay, well, based on your goals, your attitudes, your level of risk, we recommend this type of investment option going forward. So that way, if there is a big downturn in the market, I mean, there's been a bit of a downturn, but it's nothing like what happened during the global financial crisis. And who knows? But you just want to make sure that you're prepared, that you're not shocked by what happens if you don't make a choice. Okay, so definitely everybody should be looking at getting at least a conversation around that.
So that's
agree. That's the kind of limited advice side. Where I come in, or where the comprehensive advice team come in, is really looking at your whole situation. So a lot of the topics that we've already discussed, and especially if you're a member of a couple as well, and singles looking to plan for retirement, we look at your holistic situation. So that's how do we maximize Centrelink, looking at estate planning, if it's important to minimize tax for the estate, making sure we do that. Advice on non-super investments, okay? Giving you some projections on, okay, how long is your money going to last if you're worried about that? Looking at suitable products for retirement, okay? So again, going back to planning, all I would say is if you've come here for a reason, come and have a chat. If you've not seen us before, the way that it works is that we always have a complimentary first appointment, again, at no additional cost, where you come in, we sit down, we go through your circumstances, and we say, how can we help? Okay. We then provide you a quote to say, okay, well, depending upon the complexity of what you need done, we give you a fixed quote. Now, what you're paying for is basically my time, the planner's time, their professional opinion, their expertise, and the help also to implement the plan. The great thing about working for Australian Catholic Super, worked for them for 11 years, doesn't benefit me what people do with their super, with the advice. I get paid every fortnight, okay? So ultimately, I guess people come because they know that they can get advice in good faith, that they know that we're working for the best interests of the members, and to put them in a better position, okay? We won't do advice just for the sake of it, because it's a waste of time, waste of your money. But if there are things that we can do, we will always help you. But because I guess as an individual or a couple, you're getting the advice, we can't cover that through the administration fee of the fund. We have to charge individually. So that's where we give you that quote. And then it's up to you whether you want to proceed or not with any advice.
Fantastic, thank you. We also offer a member portal where you can track your super. It's just like online banking, which I think most of us are used to. And it's really easy to register. If you haven't done so already, I highly encourage you. Here's a summary of what's in the portal and what you can do. For example, you can change your investment options. And really going back to what Tom said a couple of minutes ago, that limited financial advice that comes at no additional cost, it's already covered with your member fee. And I always encourage the members that I speak to take advantage of that service that you're already paying for and have one of those limited advice appointments, at least once a year. Why not? You're entitled to do that. And it's great to review your super. But in the meantime, make sure you register for the portal, you have a look at how your super's going, you keep track of it, and that just helps you really feel a lot more comfortable and confident about how you're tracking towards your retirement. So what can you do right now? Well, it's time to take action. Hopefully we've inspired you to pull your finger out and, register and log on to the member portal, check out how your super's going, speak to your regional manager. We're available for face-to-face meetings now in our regional offices. We've got 2 offices in Sydney, 1 in Brisbane, 1 in Canberra, 1 in Townsville, Port Macquarie and Perth. You can book an appointment to talk to our financial advice team as well. And there's going to be a little survey that's sent to everybody that's registered today where they can click on a link within that survey and indicate their interest to speak to either a regional manager or one of the financial advice teams. Because I know a couple of people have asked that question, how can we connect? You can contact us, you can call us, you can email us, you can visit us. And questions, we've gone a little bit over time, so we've made a little decision in the background to finish up this session because we don't want to take too much of your time, but we have made note of all those fantastic questions that are coming through, And we really are absolutely chuffed with how engaged everyone's been. It's been a great session, but we will get in contact with each of you, so long as we've got your contact details in that registration sheet. And anything from you, any final words, Tom?
No, thank you, Tanya. That was the first time that we presented together, so hopefully you think it went well. I think it went well. We had a lot of questions, which was good.
Yep, that's fantastic. Thank you, everybody, for your time. I'm going to end the slideshow now, and we really look forward to catching up with you soon. Thanks, everyone. Bye now.